But then we have another geopolitical conflict going on. Hamas and Israel are getting into it in the Middle East, and therefore the Kerry Group is moving out there. And of course, that's going to open up the money spigot from the U.S. as we're going to spend more money there. So whatever we may be saving in Ukraine, it looks like we're going to be spending over in the Middle East. So net doesn't help the economy any and keeps that money spigot running to the military contractors. We'll see whether that conflict blows up into something bigger. Certainly that area of the world is definitely a hotspot in terms of global conflict historically. So we want to follow that very closely to see if that spreads. Think of it like a financial contagion, but it being a more of a cultural and political and military contagion, whether that spreads and causes further conflict across the world and who gets involved in that. This could be potentially a powder keg for something bigger. We'll follow that.
Welcome to Gold Silver Pros.
Everybody, this is Rob Kientz with GoldSilverPros.com. This is your weekly market wrap for October 9th, 2023. It is a Monday. We've got a lot of economic data to go over. More importantly, big stories in the second part of the show. And then to end up, some pretty big movements in the gold market on the COMEX that we'll go over and give you some idea where that gold price may be going. Stay tuned for that. But starting off, we're going to talk about the economic data. Here is the economic data that you need to know. Consumer credit plummets $15.6 billion as student loan payments resume. And we've been talking about student loan payments on this program here for about 2 to 3 months. And the use of consumer credit is plummeting as people are now paying off their student loans. We knew that when they went to pay off their student loans, that would be less spending on other debt balances and less spending overall on goods and services. So we're expecting this is a predictor of what's going to happen in the economy. We're going to continue to slow down and go into recession. Total credit card debt, however, even though the last month was a reduction in credit card spend, tops $1 trillion. That's $1 trillion. We're now talking trillion in most main debt markets, 1.5 trillion in student loans, several trillion in mortgage and real estate debt, and now $1 trillion in credit card debt. That's how much needs to be paid back to keep the system up and running. And I don't think all of it can be paid back, which is going to be the big issue. Wages stick at about 0.2% gains from last month, so they're not going up as fast as inflation. So wages are not keeping up, which is going to continue to put pressure on the consumer and their ability to do anything, whether it's paying back loans or buying goods and services. Seeing as consumers are about 72% of the economy, that means about 3/4 of the economy is under a lot of strain at the moment. On the business side, manufacturing growth is slowing, up just 0.9 points over the last month. Still not growing a lot, but just slight growing there, but overall a decline from what we've seen in years past. Construction spending slumps to 0.5%. ISM services survey down 0.9% to 53.6. It's positive, meaning 53.6% of people are positive about where services is going in this country, but it's slowing down, indicating we're getting closer to a recession. Now, when that goes negative, that'll be a big recessionary indicator because it means the largest part of the economy, services, is not doing as well. And the people that participate in it are thinking that they're heading to a recession, which means the economy is heading to a recession. Factory orders did rise just a bit, 1.2%. When discounted for inflation, that's actually a negative number, but at least it's a positive nominally, so I'll take it. Jobs. The jobs report came out, and the BLS reported 336,000 jobs created on a blockbuster report. ADP, on the other hand, the same week, the private payroll measure only had 177,000. I'll leave it up to you to determine which number you actually believe. A deeper dive shows that most are part-time. Over 1.1 million are part-time, and 885,000 full-time jobs have been lost. So it's not the same quality of job, even if there were jobs created. It also means it may come without benefits or other things that help the consumer deal with long-term investment and long-term medical costs. Employment rate does not fall. It's sitting steady at 3.8%. Labor force participation stands steady at 62.8%. By the way, that's about 3 percentage points less than before the Great Recession in 2008. That's right. We have not recovered to pre-Great Recession levels on our employment. It's down. Initial jobless claims did surge to 207,000, up about 2K from last month. And you have to question whether the employment numbers are correct. When the initial jobless claims surge, the overall employment rates don't fall, but yet the BLS is saying we created jobs. That doesn't make a lot of sense. And when you look at the ADP number and you look at the deep dive on the BLS report and show that the over 1 million jobs created were part-time and 885,000 lost were full-time. You can kind of see how valid or what the efficacy of that report is. Even though there's some jobs credited, they're not quite as robust as the initial top-line number the BLS would suggest. So when you get that headline number from the financial news, remember, you got to dive down, and we do that on this report for you every single week or every single month when that gets reported. Job openings rise to 9.6 million, up 700K from last month, indicating that there are certain jobs that are not being filled at the same time that jobless claims have jumped. The question there is, are people qualified for the jobs, or are they not able to find them, or what is going on there? That's a big question that we will follow as we get deeper into the recession. On the markets, stocks are down about 0.5% on news of conflict in the Middle East. This was as of this morning. Oil prices are rising again, jumping 3% on the news. Overall negative on the markets, unless you're a commodities investor. But if you use a commodity, which is all of us, that's negative in terms of inflation. On the bond side, bond rates all rise on news of geopolitical tensions. The one positive thing is the 10-year, 2-year inversion falls down to 0.286% as the 10 and 20-year rates both surge the most. That's also because yield curve control efforts by the Fed are underway and the Treasury working together to control that yield curve to keep it from falling further negative. I think ultimately they will fail, but short term, they're certainly having an effect there. Corporate high yield or junk bonds are down 1.42% on the month, a little bit less risk seen there by the market. The repo market up slightly to $1.283 trillion. That is the short-term lending market that keeps the wheels of the economy going when people need to borrow money short-term or lend money short-term. But that's down from 2.18 trillion to start the year. So that repo market has been running off, less liquidity in it. If it gets below a certain point, we know what happens. The economy can stop. So we're going to continue to follow that for you guys. The overall trend is down, even though recently it was up. That is concerning. Municipal bonds down 0.71% in October. That's good news. And mortgage-backed securities down 1.23% in October. That's the S&P Global Intelligence Index that I'm quoting there. And the crypto side, early trading shows Bitcoin down 388 points this morning, responding negatively to the conflict that's going on in Israel, which we'll get to in the stories of the week in a little bit more detail. Ethereum is also trading down 44 points. Tether was even in early morning trading. All right, next up are the stories of the week. All right, we have a lot of stories for you this week. We're going to do the usual economic ones, and then I'm going to talk about the geopolitical conflict that's going on over in the Middle East. First story for you comes from oil price by Metal Miner. Rare earth prices skyrocket following Burmese mining suspension. Myanmar's Kachin state, supplying 38% of China's rare earth imports, halted mining, causing an immediate spike in global prices. The long-term effects of this suspension might lead to scarcity, illicit mining, and environmental issues in the region, according to the report. China's economic slowdown combined with geopolitical risk highlights the need for a diversified sourcing in the rare earth market. The rare earths MMI, the monthly metals index, according to the report, witnessed another steep increase month over month in price. Indeed, supply disruptions remain a massive concern in the rare earth industry, so rare earth magnets and other materials witnessed renewed bullish strength across the board over recent months. In August, market worries arose prior to a planned environmental inspection of China's Jiangxi province. The Chinese region serves as a major location for Chinese rare earth supplies, and I will note that China processes about 90% plus of the world's rare earth supply, so they are almost a monopoly in the supply chain, although they don't supply all the rare earths. The end product usually runs through China. According to the report, along with this, Chinese stimulus efforts managed to boost rare earth production, although this cannot add long-term support to the index. It is a temporary measure. According to the story, following this, Myanmar's Kachin state suspended mining activities. Myanmar, formerly Burma, is a pinnacle producer of global rare earths and rare earth magnets, and any change in Burmese mining activity can significantly alter the market. Therefore, the mining suspension led to stockpiling ahead of peak consumption and caused Chinese rare earth prices to hit their highest point in 20 months. The question is, how will the Burmese mining suspension impact rare earth prices globally? From January to July 2023, Myanmar's Kachin state supplied 38% of rare earth materials imported by China. Despite this, mines to Burmese state shut down in early September to prepare for inspections. The shutdown raised anxiety about supply interruptions and prompted hoarding of precious metals, rare earth materials worldwide. For now, analysts expect the recent mining restriction in Myanmar's Kachin state to have the most impact in the short term. However, it could affect long-term rare pricing with these falling 3 points. While the long-term effects of the mining restriction remain unknown, it could result in a scarcity of rare earth minerals. further increasing costs. Point two, the restriction might also lead to increased illicit mining, which is already a significant problem due to China's control over rare earth mining in Myanmar. Over time, this could exacerbate environmental issues in the region and lead to political unrest. And lastly, additionally, the restriction could eventually cause harm to Myanmar's economy and its mining sector workforce. That's because China has such a stranglehold in that market, and Myanmar is such a big supplier. Moving on to the markets. What's going on in the markets? Turmoil in markets sets up a flight to quality. This is from Michael Miska, Bloomberg Markets reporter and strategist. Quote, markets are already being rattled by soaring bond yields and slowing economic growth. Now geopolitics and an escalating conflict in the Middle East are adding to investor worries. The quality factor as an investment style could be the best to protect portfolios. So in other words, the story is going to go on to say that people are going to get out of less quality stocks and into higher quality ones. Here's a quote. Quote, a macro backdrop of slowing growth and the recession risk is a favorable environment for quality stocks, say Bernstein strategists led by Sarah McCarthy, adding that valuations on shares covered by this strategy in Europe have eased versus the broader market. The relative multiple has fallen from 1.6 times to 1.3 times. This D rating offers a good entry point into quality stocks. A Goldman Sachs basket of stocks screened for quality attributes such as stable growth, strong balance sheets, and good profitability has underperformed the broader market this year, rising just 1.4%, while the stocks 600 is at 4.5. In other words, while the quality stocks have not seen the inflows, people are going to inflow to the quality stocks. And what you're going to see is pressure, in layman's terms, on the edges of the stock market. So look at your stock portfolios. If you feel like you have a lot on the edges of the stock market, this may be a time to reevaluate based upon research by Goldman Sachs and Bloomberg Markets. Another top story of the week is reshoring. We're bringing manufacturing back to the United States. According to Bloomberg, reshoring mentions by top execs soar in earnings calls as made in the USA gains traction. So the quote is, Bloomberg data shows the number of times corporate executives mentioned nearshoring, reshoring, and onshoring, and third quarter earnings calls jumped an average of 216% year over year since the start of 2022. Already, private companies had announced $516 billion of investments in domestic projects since President Biden took office, according to the latest figures from the White House. And this comes as former President Trump's trade war kicked off the entire movement to make manufacturing great again in the U.S. Quote, the trade war with China was the first big shock, said Bloomberg senior geoeconomics analyst 𝘎𝑪𝑑𝑝𝙂. Continue quote, but it was the pandemic that crystallized the fragility of the globalized supply chain, spurring companies to accelerate their nearshoring plans in earnest. Backlogged ports and high-profile shipping blockages and the all-important Suez and Panama canals illustrate the risk of relying on cheap production in Latin America and Asia, while advances in automation and rising freight costs have made it more economically attractive to move production back to the U.S., Bloomberg writes in a report. Here we go. I'm talking about this for a while. Manufacturing is coming back to America. Not only geopolitical conditions, but rising costs and problems in the Chinese economy, as well as the political direction by the previous administration. A recent note via Goldman, according to the article, showed most of the manufacturing investment has been in semiconductor plants, thanks mainly to the CHIPS and Science Act to reshore semiconductor supply to America. The Biden administration can take some of the credit. Quote, these trends were happening with or without governmental stimulus. MCOR CEO Tony Guzzi told Bloomberg. He added, the government stimulus solidifies demand or elongates demand. So it definitely helps in the longer term, although the initial impetus for reshoring a lot of the semiconductor activity was by the private sector. Next story, as we get into the geopolitical conflict, and I'm going to give you what I'm getting from a bunch of different points, and I usually don't comment too much on geopolitical conflict, so I'm only going to cover the big points for you. You guys want to find your trusted sources across the internet to go into more detail. A quote from Zero Hedge, Israel orders complete siege of Gaza barbarians as death toll tops 1,100. Quote from the story, the total death toll among both sides as all-out war between Israel and Gaza militants enters its third day has topped 1,100, with most of these deaths being Israeli at an estimated 800. Israel's defense minister has as of Monday ordered a complete siege of Gaza, which alarmingly includes cutting off all supply of electricity, food, and fuel, but even water of a densely packed population of 3 million people in the Strip. Yoav Gallant said, I have given an order. Gaza will be under complete siege, he added. We're fighting barbarians and will respond accordingly. At the same time, a statement from Energy Minister Israel-Hamas confirmed, quote, I instructed that the water supply from Israel to Gaza be cut off immediately. Meanwhile, the IDF continues to pound the Gaza Strip on an unprecedented scale, with top Israeli officials increasingly voicing their approval for the ground invasion, which some say is imminent. Quote, Israeli strikes in Gaza have killed at least 493, including dozens of children, and left 2,651 injured, according to the Palestinian Ministry of Health. An incursion by Gaza militants of this scale has not been seen in Israel since the nation's founding in 1948. According to OSI Technical, quote, can confirm that images showing Hamas beheadings of IDF soldiers exist. Do not go searching for them. Haven't seen images that magnitude since ISIS was prevalent. This is on Twitter. Also, Twitter reports indicate that the Gerald Ford aircraft carrier is moving towards the Middle East, along with a battle group to go along with it of some warships. According to Reuters, Qatar is currently seeking to mediate hostage negotiations. The Palestinian side has demanded the release of some 5,000 of their own who have been held in Israeli jails, sometimes for years. They're believed to be Americans currently in captivity in Gaza. Quote, a spokesperson for the NSC and the agency can confirm the deaths of several U.S. citizens, but not provide a specific number. We extend our deepest condolences to the victims and the families of those affected and wish those injured in a speedy recovery, the spokesperson wrote in a statement shared with The Hill. U.S. State Department spokesman confirms the death of 9 Americans in Israel, and BBC is also reporting that at least 10 British citizens are feared dead or missing. Ben Gurion International Airport has come under the barrage of rockets fired from the Strip. Breaking, according to The Cradle on social media, on Twitter, direct hit on Ben Gurion Airport, Tel Aviv, by the Palestinian resistance missiles. We're going to have more war going on in the Middle East. I will make this statement. Be careful of what you believe, even what I just told you, because either there's going to be propaganda or misreporting going on in this type of situation. I've been told by a lot of people who have experience with these things that the initial information is not always the most correct. Of course, we saw that with the pandemic and other big geopolitical events. So just stay tuned to the news. We'll continue to try to provide the best information we can find from reputable sources like we did today. But again, take everything with a grain of salt because I'm not 100% sure this is all correct, which is why I'm very careful when I report on this on my channel. But just know that conflict is there. We're sending warships. Israel has basically declared war on Hamas in the Gaza Strip. They're removing support, just basic life support, and they're fighting. Basically what's going on, that's what we know right now. Whether this turns into a bigger geopolitical conflict, I have no opinion at this time, but we'll continue to cover it. Last story of the day before we get into the gold and silver report. Quote, we no longer feel safe, unquote. Paris residents fear next wave of migrants arriving from 𝘎𝙬𝙊𝙍. Authored by Thomas Brooke via Remax News. Quote, concern is mounting in the French capital over the latest wave of illegal immigrants to head from the Italian island of 𝘎𝙬𝙊𝙍 to northern Europe, with Parisian residents worrying about their own security. Several local residents discussed the value of immigration with the French broadcaster CNews, expressing their fear that Paris could see an influx of new arrivals with tens of thousands of migrants landing on Italian shores in recent weeks. Quote, we don't feel safe, one resident of the 18th arrondissement near the Jardin-d'Eau told the channel, excuse my horrible French pronunciation, explaining that a number of newcomers to the neighborhood had participated in civil disorder and organized crime, including drug trafficking. They fight and cause problems, added another resident who admitted she felt scared and intimidated by groups of adult males loitering in the neighborhood. You regularly have clashes, cases of alcoholism and drug addiction on the public roads of these neighborhoods. And unfortunately, networks of crack traffickers who take advantage of the presence of these people, said Pierre Licia, regional counselor for Île-de-France. Other elected officials have called for strong measures to be put in place to relocate newcomers from the streets to more secure accommodations in an attempt to clean up affected neighborhoods. Quote, I'm calling for a major emergency plan for the northeast of Paris to get migrants out of the street as a dignity that we owe them and thus resolve the problem of local residents who are on the front line of nuisances and inconveniences, said Parisian Councillor Pierre-Yves Bournazel. The European Union is currently discussing asylum reforms in a bid to prevent migrants from entering the bloc and traveling at will to desired most prosperous nations. 𝘎𝙬𝙊𝙍 has been inundated with scores of illegal immigrants arriving in small boats from the African mainland, many of whom continue to migrate north of Italy and cross into France and Germany. Polish Prime Minister Mateusz Morawiecki stressed ahead of informal summit of EU leaders in Granada, Spain this week, that his government will never agree to use asylum proposals, adding that Poles do not want another 𝘎𝙬𝙊𝙍 in Poland. We're at a turning point in how Polish sovereignty and borders will be treated. For the opposition, PO and the European Commission, borders are obsolete, Morawiecki said. That's the end of the stories we have for the week. Stay tuned next for the gold and silver report. Something I'm very excited about are these 5-ounce silver bars, a gorgeous design made by my friend at Eagle Forge Bullion, made by someone who's been in the military and is a patriot, and he's got 4 awesome designs. This is the skull and crossbones design, probably my favorite, which is hand poured and hand cast. This is the Eagle Freedom design, which I love. If you're a big fan of eagles and freedom and that design, this is the Don't Tread on Me, where it's got the symbol of the snake from the flag, which is awesome. These are all custom, guys. And of course, the classic Come and Take It bar, which is awesome. Prices are down on silver right now, guys, and with this sale, this is a killer deal. This is the cheapest we've ever had those bars. All right, here we go with the gold and silver report, ladies and gentlemen. I'll go ahead and present screen and show you what we're seeing on the markets. Of course, we always start at the CME Group's website, where we check volume and open interest and settlement of closing prices and talk about the trade and which months are receiving it. As you can see, we still had steady trade in the gold futures dating back to the end of September, going through October. I think as we get closer to the end of the year, people are going to participate more. There's going to be more open interest. Open interest is just a measure of the long and short contracts on the market. As we look at data from Friday, actually, this is data from about 9:30 a.m. today. On the globe, it's 243,109 contracts, total volume of 248,232. EFPs 3897 so far today. Deliveries 320 on the October contract. Notice down here, the October contract only has 512 open interest contracts. So you can't get a lot of physical deliveries in the here and now when most of the trade in the futures market is in a future month. So what we expect to see, for those of you who have never watched this report, is that in December, which has a dominant amount of contracts to the tune of 366,591, is going to see a lot of deliveries, and it typically does every year, but you can still have some along the way. Going back to Thursday's data, we saw 148 deliveries and 6,806 EFPs. What is an EFP? It's called exchange for physical. That's where somebody takes a futures contract in the US on the COMEX market and goes over to the London OTC market or the UK OTC market and tries to either exchange for a paper contract there or get access to the physical. It indicates that there is either a difference in price between the two markets where they're playing arbitrage, or somebody wants the physical, and because this is a light delivery month in October, they may not get it. So it's pulling forward of the physical or playing the price differences that exist. That also implies, since you're doing that the prices are higher overseas, which they are in Shanghai, which we'll show you in a moment. Going over to Wednesday's data, 179 deliveries in gold, 5,145 exchanged for physicals. Wow, a lot of deliveries in October. On the 3rd, 2,572 gold contracts, or 4,085 EFPs. And we go to Monday's data, 2,499 deliveries on the physical COMEX market, while 5,000 contracts went over to London. We're going to go over to settlements. And when I go to this tab, we're just looking at price settlement. We look at the dominant month, or the one that has most contracts, which again is still December. So that's where the prices really are determined on the market. It's not determined by physical trade. It's determined by paper trading on this market. In the dominant month has the biggest effect on that price. Estimated volume as of 12/31, which is about 15 minutes ago as I record this, 157,000 contracts. That is today. Settlement price is up $19. Gold has recovered a little bit, probably because of what's going on in Israel, along with the issues with the economy, but probably the Israel and Hamas issue is causing gold to rise, as would be expected. So it's up $19 today. We go back to Friday's data, it was up $13.40 and on to settle about $18.45.20 on the December contract. And on Thursday's data, it was down $3. And on Wednesday's data, it was down. So it was down until about Thursday of last week, which indicates what's going on across the world does have an effect on the gold price. Let's see what's going on in silver. This is the volume and open interest. Again, end of September, bigger volume and open interest in silver indicates a bigger interest in the metal, whether it be the pricing or the physical. As we look at the data from Friday, we had 118 deliveries. Again, weak delivery month here, only 29 contracts open. So you're only going to get so many deliveries when you don't have a lot of open interest contracts. And what's going to happen is a lot of those are going to move over to the UK. 165 contracts here on Friday's data. Overall, 106,000 contracts trading. Looking at Thursday, 799 went over to London, 17 deliveries. Going to Wednesdays real quick, 2,596 contracts EFP'd over to the UK right here, and 34 deliveries. You see the pattern. I do this every week so that you can understand the pattern of how this works. Is to show you also the short-term movement so you can see what's going on, but so you can train yourself and understand how this market works. The more you understand how this market works, the less you panic of whether the price moves up or down. You start to get an idea of when it's going to move up or down and become more confident in whether you're trading or buying and holding these metals. All right, looking at the preliminary data on October 9th as of 12/31 in silver, that's today's trade, up 20 cents on the December contract. on the strength of 53,190 contracts. We're going to go to Friday now. Refresh the screen. Friday was up on the December contract 70.4 cents on the strength of even more contracts, 84,533. Of course, that was a full day's data on Friday, whereas Monday we only had a half day's data, as you saw the timestamp. Unfortunately, Thursday, silver was down 12.7 cents on the strength of 57,800 contracts. And Wednesday, you're going to see it down 23 cents. And Tuesday of last week, you're going to see it down 4.4 cents. That tells you what determines the price. Now we got to see what the traders are doing. For that, we go to the Commitment of Traders report and we see their positioning. Now, this is an old report in arrears because it takes about 7 to 10 days for the CFTC to collect all this data and to put it in a report. I will point out they're collecting data from data providers. They don't have it directly from the COMEX, at least according to them. The last time I checked a few months ago. So they can't just put this out right away, or so they say. But it's interesting to see, even though we're taking a look back by about 6 days, what's actually going on in the market. Okay, producer merchant category. These are the producers, the miners, and the merchants are people like Apple and Samsung and all those people that use silver in their products. Decrease their longs and went a little bit more short. They're expecting the price of silver to fall. So they're taking insurance against it. You take a futures contract in the direction of the position, you expect the price to move to ensure that price risk. And think about that, and I'll explain that dynamic in future reports. The swap dealers, also known as the bullion banks, or the big baddies on the market, which really have the biggest positions. If you look at the 8 or less traders, long or short, you see the bullion banks hold 46.3% of the shorts and 23% of the longs. That's these dudes right here. They actually dropped their shorts by 4,000 contracts in silver and dropped their longs by 1,200, a net move of about 3,000 contracts net long when you consider they dropped or got rid of more shorts. And that's put them in the position of having 31,000 long contracts and 32, almost 33 short. They're still net short by about 1,800 contracts, which means that the banking sector expects the silver price to fall a little bit, or at least their clients do. They put the trades in for. Managed money, which are the financial houses, hedge funds, those types, dropped longs and went heavily short. So they did basically the opposite of swap dealers and took the opposite side of the trade. They're expecting the price to fall. Other reportables, which are wealthy family offices, wealthy individuals, those types, 3,164 contracts long, 408 short. So they went more long. So they're expecting to go long. Moving down to gold, this is gold as of the same day, October 3rd. We see the steady roll off of swap dealers dropping their short positions. They're going net long week after week after week after week. I point this out because they tend to, especially when you see a long-term trend of them moving one way or other in gold, are tending to tell you where the price is going to go before too long. They've been slowly, just surreptitiously rolling off these short contracts, going net long in their contracts, and now they're down to 175,000 shorts and 85,000 longs. That's only about a 90,000 contract difference. It used to be 2.5 times. Now it's about a 2 to 1. That tells me that within the next few months, if they keep this up, more than likely they're going to get closer to an even position of gold. That means gold's probably going to rise at that point, and I mean bigly. Normal gold market movements, when it moves just up a couple of percentage points, you don't see the swap dealers over time dropping this many contracts. The fact they've been doing this now for a couple of months that we've been reporting on means that they see a longer term rise in the gold price, probably because of geopolitical conflict, economic issues, and the like. I think that's very bullish for gold moving forward, even though it takes time to get there. And I realize you want it to happen right now. A lot of people, you're like, do it now. But we have to understand the reasons why. And the bullion banks look long-term. They have data. They look long-term. They're looking long-term here. Long-term, that's very big. And by long-term, I mean like 6 to 8 months. They think apparently gold's going to rise quite a bit. At least they're reducing their short positions. That includes them for the house counts and the clients that they trade for. Overall, net long, the producers went net long by adding 3,400 contracts. The managed money took the opposite side of the trade of those two groups, dropped a bunch of longs and went short. They've never been considered the sharps on the market. So I generally see that and say they're probably going to lose a little bit of money on that trade. The other reportables also went net long. So the people that matter are going long, or the people that typically invest not only for the short-term price movements, but over the long-term trends. The other reportables and swap dealers and producer merchants are moving long. So everybody's expecting gold to go long in this environment. Looking at the ETFs and looking at the American market, and then this is mostly UK with some American market in it, the ETFs, We like to see what's going on. Overall, in the COMEX, in gold, we've seen a 4-week change of an increase in eligible on the depository. Eligible is not immediately available for trade. It's basically private storage held, which could be eligible to put into registered. Registered is where you would actually put it up for a contract, which is his top category here. So registered has actually gone down almost 1 million ounces over the last 4 weeks, about 746,000, and daily 86,000. But eligible, more gold is moving on. Not as much as moving off the net at the bottom. Across all markets, you'll see gold has been moving off the exchanges as people take it into private storage or use it for other purposes, investment purposes, collateral purposes, central banks to shore up their balance sheets. That's what we're seeing in gold, although it's interesting to see in this category a little bit of gold moving back onto the American exchange. Moving over to silver, we're now on silver depositories. The 4-week change in silver, very similar trend, a little bit more moving into eligible. Now, it's not immediately tradable, but it is eligible to be traded. So we'll see that silver is going to be put up to deal with the declining silver inventories on the COMEX we've been talking about for months and months and months, which has been going on for 2.5 total years on the COMEX. Net, there's actually been a net increase in silver across the world, most of that going into SLV. That's right. The retail has come back with a force over the last 4 weeks, and they are pounding investment into SLV. SLV, of course, is an ETF. You buy a share. SLV is responsible then for buying the silver to support that. So either SLV needed to buy silver to shore up previous investment or new investment in SLV, and that means that the retail is very bullish on silver. Usually retail buys silver for investment purposes, not industrial purposes, so it's interesting to see that dynamic. Last part of the gold report, Shanghai Gold Exchange, the COMEX gold futures spread, which is the price on the equivalent Chinese contract. The higher this number is that I've got highlighted right here, and let's make this a little bit bigger so you can see it. This number right here, the higher it is at 56.4 positive right now. It means that about the same thing, same size contract that gold trades for in the US is now $56 more expensive in China. The reason I always point this out, China is a much heavier physically traded market. Around 75 to 77% on a monthly and a yearly basis of gold is delivered on contracts in China. So it's a very physical market. So when that price is higher, that indicates that physical demand is very strong and is going to pull up the price. All right, we're going to give our summary report on what's going on in the market. Let's wrap it all up and I'll give you my opinions. Geopolitical conflict is increasing, not only in Russia, Ukraine, where the media coverage has died down, but Russia still holds a lot of the eastern Ukraine there and is continuing to hold that. Conflict continues to rage. The Congress basically voted out the House Speaker, which seems to indicate less spending on Ukraine. Of course, a Ukrainian president basically freaked out, was the headline I read, thinking that the money that's been coming to Ukraine from the U.S. may be threatened. But then we have another geopolitical conflict going on. Hamas and Israel are getting into it in the Middle East. And therefore, the Kerry Group is moving out there. And of course, that's going to open up the money spigot from the U.S. as we're going to spend more money there. So whatever we may be saving in Ukraine, it looks like we're going to be spending over in the Middle East. So net doesn't help the economy any and keeps that money spigot running to the military contractors. We'll see whether that conflict blows up into something bigger. Certainly that area of the world is definitely a hotspot in terms of global conflict historically. So we want to follow that very closely to see if that spreads. Think of it like a financial contagion, but it being a more of a cultural and political and military contagion, whether that spreads and causes further conflict across the world and who gets involved in that. This could be potentially a powder keg for something bigger. We'll follow that. Also going into the commodities markets, they're spiking. Rare earths are spiking due to some inspections going on in Myanmar. Oil is spiking because of what's going on in the Middle East, but also because of the restrictions of OPEC and Russia on oil as they reduce their total output. We've seen some onshoring in the U.S. and bringing back of the manufacturing. As I look at all of this holistically, I think what's going on is we're getting rid, the de-dollarization is shifting the commodities trade, as I've been saying. The U.S. is now starting to bring manufacturing back and production back or rely on its nearest neighbors in Latin America, which I think ultimately is a good thing for the U.S. and reducing some from China. China's becoming more independent, building up their middle class and building up their own trade network, the Belt and Road Initiative for the BRICS and for other nations. Many other nations are involved in that. So it's starting to see trade regionalizing. I think we're starting to see regionalization of the currencies and the dollar as well, which is going to put incredible downward pressure on the US dollar. Right now, The dollar is up a little bit last week, which caused some fade in gold. But I think long term, dollar valuations are going to go down as central banks get rid of it and go down to that 40 to 50% level of global reserves. Everything seems to be according to plan, at least in terms of what I've been seeing the last couple of months. Last week was very pivotal on world events and commodity events and economic events. Don't underestimate the value of that over to what's going on, and more importantly, what's going to happen to the precious metals. I think they're going to continue to march up. It's interesting to see how the precious metals fell, and there was a lot of panic. Although most precious metal holders that I know didn't panic sell, which is good, but there was panic in the markets and panic in the pricing. But again, remember, that's a derivative trading. The holders aren't getting rid of their gold and silver. It's the derivative guys that sold paper. They always sell paper into what they think is weakness. That causes the price to fall. For you physical holders, that's an accumulation event. In my terms, at least that's what I do. I'm not your financial advisor. Do your own research. But whenever I see the price fall like that, and I know the world is not fundamentally sound, and the reasons that gold and silver should be going up are increasing, I just accumulate more when I can. I buy on the dip. So I fully recommend, if you're buying gold and silver, to buy on the dips. Of course, whether you want to buy in gold and silver, do your research. So your financial advisor had to put that disclaimer out there. Thank you so much, everybody, for tuning into the program. This has been the weekly market wrap-up from �GoldSilverPros.com. Stay tuned as we do this every week. We go over the economic data, the stories that you should know, and give you a detailed breakdown of the gold market. And I tell you what I think is going on with the markets around the world, particularly as it relates to the precious metals. Remember, Thursdays we come out with interviews, deep in research reports, how-tos, and a wide variety of different information on that. We're starting to broadcast more on TikTok for those of you that like short-form content, as well as short-form content on both Twitter and YouTube as well. And stay tuned to Twitter as we run a lot of polls and provide you a lot of information on that resource. Of course, we have the store here in Grapevine, Texas, if you're interested, and our bullion store at www.goldsilverpros.com. Thank you so much for tuning in. Until next time, this is Rob Kientz with GoldSilverPros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.